Economics is a very important and influential science. Economists advise the governments, run central banks, work in financial institutions, and they work in the real economy. So the theories that we learn at the universities about economics are the tools that we use in practice to run the economy. So the theories that we learn at the universities are very influential in how our society works. So that brings us to the question, does the social science called economics take behavior of people into account? How they interact with each other, with institutions, how they react to each other? And the answer is unfortunately no. The mainstream neoclassical world of economics and finance lives in a fantasy world. This is a normative economic theory based on a lot of assumptions about how the world should work. For example, people are all rational. That would be great. People make thousands of calculations and take an optimal decision instead of just reacting to other people. The economy is always in an equilibrium, and if it's not, it will revert to an equilibrium in no time. Private debt, for example, when people borrow for their houses or buying stocks, is irrelevant to macroeconomic behavior. And in the end, financial crises do not occur.
The conventional economic model, which is used to run the economy, is known as the free market or neoclassical economic theory. And it is based on the idea that we are all rational when it comes to money, that the economy will always find itself in an equilibrium, and that bubbles simply can't happen.
This approach to economics is not only useless, but it's also, in many cases, seriously harmful. You can imagine that when we run the economy based on all these assumptions about equilibrium and rationality, beliefs that are refuted time and time again, that the laws that we make and policies, regulations and even monetary instruments are very counterproductive to the way that our economy emerges.
Ain't got no home, ain't got no shoes, ain't got no money, ain't got no class, ain't got no skirts.
We need to make more use of the field of complexity, agent-based modeling, network theories, and also in conjunction with cognitive science like behavioral finance and behavioral economics. Only this way we can better understand how the economic world works, and we can implement better economic policies. We can create more robust financial institutions, and we can mitigate the consequences of financial crisis. Economics is about how households, banks, governments, all kinds of institutions work together, how they interact with each other, how they react to each other and to market prices. And people's behavior is not static over time, unlike an atom. For example, if house prices go up for several years in a row, the probability that people want to buy a house, in the first instance didn't want to buy a house at all, but seeing these house prices rising, they do want to buy a house at some point, and they start to push the market price up even further. So these kind of interactions between how the market behaves and how people's behavior changes over time is called a positive feedback loop. The market enforces the probability that people will buy even more, so actually prices going up means that the demand goes up. And neoclassical theory never explains anything about this phenomenon, about these positive feedback loops. And that's why neoclassical theory is such a failure.
That being in a bubble is like, is a state of extreme hope and excitement and stupidity.
When prices go up, people say, oh, seems like people are optimistic about the future. I should be optimistic too, and so I buy those assets, and that pushes the price up a little more.
In every boom and bust cycle, there is a period of exceptionalism. This time is different. Everything is different. And there's always a cool excuse. And things like, oh, well, our demographics are different. Or, this time interest costs really are very low. Or inflation has been solved.
So the problem with these positive feedback loops, which are actually bubbles and euphoria, is not so much that they exist, because they will always exist, but it's the fact that the government is amplifying these bubbles. What they do is, because of neoclassical theory, which ignores the existence of a bubble and of irrational behavior, because of this neoclassical thinking, governments relax the rules about borrowing money for households, lending money by banks, and even the central bank starts to reduce interest rates to even fuel the bubble more and more until it's unsustainable.
Hi, Dad.
Oh, hello, son. Sit down.
Sure.
Now, listen up, Alan.
I'm all ears, Dad.
The essence of the financial instability hypothesis is that financial traumas,
You mean crashes and such?
exactly, occur as a normal function in a capitalist economy. This does not mean the economy is always tottering on the brink of disaster.
I should hope not. What kind of system?
Son, be serious. The normal functioning of an economy with a robust financial situation is both tranquil and, on the whole, successful. But tranquility and success are not self-sustaining states.
You mean stability leads to more optimism, and therefore more borrowing in stocks and houses.
Uh-huh. And this leads to a transformation over time of an initially robust financial structure into a fragile structure.
Wait, let me get this straight. After a deep depression, governments impose regulations on the financial world. There follows a period of stability. But the problem with this stability is that it breeds overconfidence. Overconfidence leads to financial euphoria, during which time the politicians relax the regulations. This then leads to excessive borrowing, and excessive borrowing and euphoric bubbles cause instability.
By Jove, I think my boy's got it.
Well, I've been hearing about it at the dinner table since I was 6.
What Hyman Minsky tried to explain is the emergent process of stability leading to instability. And that's emergent behavior. It's not order, it's not equilibrium, as neoclassical theory tries to explain to us. It's also not total chaos or total randomness. So there's some predictable pattern in the things that we see over decades and over centuries, but it's not the order that we want to have. And of course, when you want to move from instabilities to slightly more stability, to slightly more order in our economic society, we need to understand how this instability exactly works and how we can intervene in the process that leads to people interacting with each other and leads to instability. So we need complexity to understand how we can reduce instability. So the important field of complexity can help us in many different ways in economics. Agent-based modeling, for example, can help us to understand the role of debt and borrowing to households and how governments and regulators at some point can reduce instability by putting a brake on the amount of lending from banks to households.
When we take your income and your wealth, you measure 620 on the FICO scale.
620? That's great!
No. You see, we financial wizards reckon 850 on the FICO scale is good, and 300 is very, very bad. You see, most people score about 725 on the FICO scale, and I'm afraid 620 is usually our cutoff point.
Oh dear. So I won't get my interest-only mortgage.
Oh, not so fast. You could still be eligible for a stated income verified assets loan.
What's that?
That's where you state your income and we verify your wealth.
Well, I'm worth $1 million.
Oh. Can you prove it?
Not really.
Look, we really want your money. I mean, we really want you to have this interest-only mortgage. So we can go down the stated income, stated assets route.
What's that?
You state your income and assets, and we don't check them.
Great!
Well, then that's all signed and sealed.
Believe it or not, this scene, or something like it, must have been played out numberless times. In 2004 to 2005, more than a third of all mortgages were no income, no job or assets that were nicknamed ninja loans.
Network theory can help us to understand the interconnectivity between banks and other financial institutions, and how we can reduce interconnectivity to make the economy more stable, or how we can make the most interconnected banks safer and make the economy more stable.
I wonder if their balance sheets are as bad as ours. And they sort of think, you know, they probably are because we're all doing the same stuff. And then they say, you know, maybe when that loan comes due, we should call it in. Say, we're not going to renew it anymore because we think maybe you could get in trouble and we won't get paid. Suddenly, all the banks started doing this. And basically, that is when the global credit markets froze up. Banks wouldn't lend to each other anymore. And so that turned into a massive liquidity crisis, and that is what set off the whole thing.
So when we move away from the neoclassical top-down way of working, based on lots of assumptions, to a complexity theory based on the interactions between people, bottom-up, I'm positive we can get to a much more stable financial and economic world.
Financial instability hypothesis, boom. Financial instability hypothesis, boom.